We were asking for a little more government involvement. Where are the supervisors rather than less?
Exactly.
Let's get the street's take on the sell-off this morning. Joining us today is BMO's chief investment strategist, Brian Belski. Brian, good to see you. Thanks for the time.
Thanks so much for having us today. I guess you need someone positive to come on and start talking about stocks.
We're happy to hear it. Your general point is that markets trading on feelings, not facts, I think is how you put it.
We are, unfortunately. A lot of this has been exacerbated in our view since COVID and the information flow since COVID and all of us making kind of binary decisions with our lives and with our portfolios since COVID. But again, too, I think this goes back to the great Mark Haynes bottom of March of '09. Which a lot of emotions were around the great financial crisis. But Carl, in terms of just the work, right? In terms of just the work, we've long said that we fail to give politicians any credit. I think that in our work, we're more valuation, earnings, operating performance driven than any kind of headline driven with politics. Politics, in our view, have nothing to do with the absolute performance of the stock market. You can either enhance or detract the relative, and that's what we're seeing right now. So again, let's take 2 steps back and be very humble. We need to be humble in the markets because we've had 220+% moves in markets. Number one. Number two, the market went up in 2023 for very different reasons than it went up in 2024. Now we've entered, I think, a period, and we've said this now for several months, that we believe 2025 is kind of the shock into normalization, where we're not going back to 0% interest rates. We're not going back to this heightened sense of inflation. We're not going back to this huge moves in markets in both directions. We're going to kind of go back into the mid-90s, mid-80s environment where we see high single-digit, low double-digit performance, double-digit earnings growth, a trading range with respect to 10-year treasuries. Right. And oh, by the way, if you take a look at the annual performance of the stock market since 1990, it's 10%. So I think that's what we're going to be this year.
Have you made any changes to either earnings forecasts or more broadly, any kind of macroeconomic data?
We haven't, and the fantastic Ms. Picker actually put it best. If you take a look at financials, there's been no change to earnings forecasts. In all of our work in terms of revisions, we've been tracking revisions for 20+ years. And if you take a look at the bottoms-up numbers in terms of the 500 companies in the S&P 500, we're not seeing any kind of material changes. When you roll them into the sectors, actually in February, we saw numbers go up. So I think this is all about emotion, and this is all about duration risk, quite frankly. We're trying to measure something that we don't know, Carl. We don't know how long these tariffs are going to last. We don't know when they're going to be pulled. And I think trying to invest in the unknown, you have to default to fundamentals. And from our work, again, the models have not changed.
Brian, the consensus for S&P 500 earnings, let's say for the first quarter, I know have come down from over 11% at the start of the year to something like between 7 and 8%. So maybe that's a normal pace of overall revisions. But I just wonder if that's one of those, one of those things where it seems like whether earnings hold up or not, or whether they beat in coming quarters, it feels like the direction of adjustment seems to be lower, even based on the benign view of what tariffs might be.
It's a great point, Mike, but I would say this is that you've done a good job talking about the unequal weighted versus the market cap weighted side of things. And we knew coming into the year that the Magnificent Seven, or let's just call the top 10 stocks in terms of market cap and the S&P 500, the growth was beginning to go to decelerate. We knew that, but we've also not looked at how we've seen a massive acceleration from the 493 others. That's kind of number one. Number two, coming into the end of the year, we always see this big revision, especially after first quarter, down to the downside. So some of this is seasonality. Number three, in terms of what we've seen with respect to the market, I could claim to you that the momentum trade now is into defensive names like utilities and staples. From a fundamental perspective, if you take a look at valuations and debt to equity and free cash flow, consumer staples and utilities are very expensive and don't see a lot of fundamental growth from our side. Again, it's more stock picking, Mike. But I think in terms of earnings, you're going to see more of a settle down. I think, quite frankly, it's more about the discernibility and sustainability of earnings than it is these projections. So the more stable the earnings growth, the better.
So given that perspective, Brian, I'm just curious if you think the emotion at this point has been effectively washed out. Are we close to the end of this unwind that we're seeing?
Well, again, talking about the great Mark Haynes and the washout low of March, we would love to have this perfect little sell-off that signaled everything. I think what we've learned the last few years, quite frankly, is that you never see exactly what you want to see in terms of this great sell-off. And I think when you talk about positioning going forward, Leslie, you want to understand that the stock market is a market of stocks. I think so many people in the strategist game want to make the big market call. So this is the low, or we're going to go to here. Guess what? You want to maintain that the U.S. stock market, in our view, from a longer term perspective, is the best market in the world, period. It has the best stocks in the world, best companies in the world. So you make your list now. You look at what's happening in terms of these great financial names like Citigroup and Bank of America and JP Morgan. You haven't heard anything in terms of the wealth management channel. The wealth management channel is doing amazing. So look at stocks on an individual basis. Start your shopping list. Stop trying to time the market and be a long-term investor.
Brian, good message. Appreciate it today after a couple of challenging weeks. We'll talk soon. Brian Belski.